Welcome back. It's time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back with Allan Small. He's at IA Private Wealth. To continue our conversation, Allan, about dividend stocks. Obviously, they have come down in a big way, their share prices, because investors now have many other options with respect to a safe, reliable flow of interest income. Bonds and GICs are offering rates that haven't been seen in years. So remind us what your take is on dividend stocks right now.
Yeah, so as you mentioned, we used to say TINA for a long time, right? There's no alternative to the stock market. Well, now there is one. And it's interesting, we talked about Pepsi in the last segment, and Pepsi's a name, for example, that pays a smaller dividend. And the person I heard on the radio this morning was talking about how their stock, the CEO, how their stock, because it's paying a smaller dividend, perhaps investors are looking away from a name like PepsiCo because the dividend is so small. They rather go out and get a 5% short-term government treasury instead, yielding 5% or over 5%. Why would someone want to take the risk of being in the market to earn 2 to 4% on a dividend when you can move into a short-term treasury, is what you're saying. So what I want to do is I would like to, for my investors, recommend individual names that not only can provide a good dividend, a growing dividend, but also that name that can grow as well. And we mentioned the banks.
Where there's the potential for share price appreciation.
That's right.
And you think utilities and REITs, you're staying away from those right now?
I am.
For that reason.
Exactly.
Mm-hmm.
And especially some of the utilities, great companies, but, they tend to be more for the income they provide, less for the growth. I think, as I've said, I think the banks, if you're patient, can provide growth. I think you can even go into some names that have smaller dividends, but provide a little more growth. Again, it depends on the individual investor, what they're looking for. But there are a lot of pretty big yields out there, whether it's Enbridge over 8%, whether it's Scotia over 7% on the Canadian side. U.S. side, some of the U.S. oil names are yielding well over 7%, like a Pioneer, which right now perhaps could be bought out by an Exxon. So right. There are a lot of names out there that give you a good dividend, but also potential for growth. I think those are the names I'm gravitating to more.
What about the Canadian energy producers? A big theme there has been that they are making record levels of cash flow and are committed to returning that capital to shareholders by way of either share buybacks or dividends, and numerous of them have announced special dividends over the past year.
Yeah, again, the big names I like as well, the Suncors, the CNQs, these are companies, again, paying good dividends, but also potential for growth. Obviously, the energy names, you're talking about a commodity that is quite volatile, especially today with what's going on in the Middle East. So you have to be willing to take on that volatility. But if you can, a lot of these names make a lot of sense.
And the Canadian telcos, we touched on that earlier. What do you think of the three telcos? Share prices way down.
Yeah, way down. Don't know how much growth you're going to get there. They've been way down for quite some time. A name like BCE, yielding, I think, a yield that we haven't seen in quite some time. Share price somewhere in the low 50s. This name, I think, can make sense if you're looking for pure income. How much growth you're going to get out of the telcos, I think, remains to be seen.
Yeah, shares of BCE, which, of course, is the parent of this television network, and that shows it very, very close now to the post-pandemic low. The post-pandemic low is just off the left of that graph. And so the shares are very much at historic low levels, matching the there you have the pandemic low of early. It actually looks like a more severe decline than we saw in March of 2020, and Telus is largely the same as well. Why are you not constructive on share price growth among the telcos? One of the arguments in favor is the Canadian population continues to grow in a big way by way of immigration, and one of the first things that a newcomer to Canada needs is a cell phone.
True. I just don't see the growth there, to be honest. And it goes the same from the U.S., right? Whether it's an AT&T and Verizon, those stocks have been struggling as well. I think that whole sector is struggling for growth right now, trying to figure out what they can do to get some growth into their business. And so growth rates are down. Again, I think their dividend for now is secure on a name like BCE. But if the yields get too high, that price comes down too much. people are going to start to question whether that dividend is sustainable.
And of the big 5 Canadian banks, you like 4 of them: Scotia, TD, Royal Bank, and CIBC. Why those 4?
Yeah, I like the sector as a whole, I guess. I think obviously a name like Scotia, you got the highest yield there. CIBC, again, almost a 7% dividend yield. If you want to go with some of obviously the 2 big banks, even those names now are yielding close to 5%. I think TD is the one that I would go into if you're looking for growth and a pretty good dividend, whereas the other 2, Scotia and CIBC, you're probably in it more for the dividend than the growth. I think TD right now, with its exposure to the U.S., and I believe the U.S. markets will rise heading into year end, I think a name like TD will benefit from that.